Welcome to our monthly market debt outlook for November 2022. We've been operating in a global mixed environment of slowing growth and elevated inflation, coupled with monetary policy tightening by central banks, which has been front loaded in order to stem inflation and inflationary expectations from being persistent and entrenched in the economy. In the early November Fed meeting, Fed raised rates by 75 basis points and market expected a Fed pivot to happen, which did not come in as expected. However, Fed in the policy statement mentioned that it will consider the lags with which monetary policy actions come into effect in economic activity, inflation, and other financial conditions, which will be a key point to note to monitor the incoming data to see how Fed looks and reacts to this in the December policy. On the global macro front, we are seeing growth forecasts being downgraded and PMI is also coming in lower. Whilst in the US, if you look at inflation continues to remain elevated at around 8%, whilst their long term average target is 2%. So, until and unless US Fed sees that this inflation in the next 9 to 10 months is coming towards their long term average target, they would want to continue to raise rates. Whilst they may slow down, but the rate hikes can continue till inflation continues to remain elevated. If we look at Europe is on the brink of a recession, but again they are also being facing the problem of elevated inflation, which made ECB raise rates by 75 basis points in the end of October 2022. Chinese data on growth and inflation continues to come in lower on the back of zero COVID policy is what they are following. Hence, their economy is not performing to the optimum level. Domestically, for us, we are seeing an ongoing and broad economic recovery. High frequency indicators like GST, PMI, and capacity utilization also point towards a strong economic recovery which is happening for India. Inflation levels in India last came in at 741, and now this month inflation should come in below 7%. And from here on, we expect inflation trajectory to come lower and within RBI's target zone by end of Q4 of this financial year. Credit growth also is strong at about 17.9% YOY, and deposit growth is lagging credit growth at about 9.6% YOY. This is keeping pressure on short-end rates as banks need to issue CD, and RBI is also tightening their liquidity. With tightening liquidity and increased supply on short end, we expect credit spreads also to increase gradually from here on. From an investor's perspective, we expect RBI to move in similar direction to that of developed market central banks, and we expect RBI to increase terminal rate to 6.5 to 660 from the current 590 levels. Given that risk seems to be appropriately priced at these levels, and long-term debt investors looking at accrual and a window of capital gains once the interest rate cycles turns lower from here, investors can look to invest in our target maturity debt funds of various tenors that we have. Open-ended debt funds also make a case in point since the tightening cycle is at a near end and fund manager has the flexibility to modulate duration over there. So investors can look to invest in our short-term debt fund, banking PSU, or corporate bond fund. And investors at the very short end of the curve should match the horizon of their investment to the fund's duration, since there is steepness still available at the very short end of the curve.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
म्यूचुअल फंड निवेश बाजार के जोखिमों के अधीन है। स्कीम संबंधी सभी दस्तावेजों को ध्यान से पढ़ें।